Well, a warm welcome everyone, and thank you for joining me today. My name is Joel Carty from Solace Financial. Today we have Rob Tucker from Chester Asset Management. Rob is the founder and lead portfolio manager of the Chester High Conviction Fund at Chester Asset Management. With over 25 years of investment experience, Rob spent a decade managing institutional portfolios at HSBC, including 5 of those based in Hong Kong. Prior to establishing Chester in 2017, Rob held senior investment roles at SG Hiscock and began his career at Merrill Lynch. He is recognised for his high conviction investment style, underpinned by deep fundamental research and a strong emphasis on downside risk management. But before we get stuck into our discussion, I would quickly like to provide a general advice warning. As we go through today's discussion, we'll be discussing financial information which is general in nature, meaning it doesn't take into account your own objectives, financial situation or needs, so it's not a recommendation. It's important that you consider if what we discuss today is appropriate for you before acting on it. Please also refer to any product disclosure statement regarding the financial product for further information. Details of this general advice warning can also be found at the moneysmart.gov.au website.
Thanks for joining me today, Rob. As a fund manager specialising in Australian equities, can you talk us through Chester Asset Management's history and investment philosophy?
Yeah, sure, Joel. And look, and thanks for having us along. I'm very happy to talk about our product and our strategy. So I appreciate the interest. So Chester started in 2017. Anthony, Luke, and I have all worked together for really about 15 years now. And we previously worked at a place called SG Hiscock. And the reality is we owned a small part of the business. And if we had been there now, nearly 10 years later, we'd own about 2% of the business. So it was really setting up Chester in 2007. It was really about taking our own destiny into our own hands. So that's what we did. And so our fund, the Chester High Conviction Fund, has a 3.5-year track record at SG Hiscock and then 8.5 years at Chester. So it's just ticked over 12 years of the same strategy. And our philosophy is very benchmark unaware. And in that context, we do genuinely believe we're trying to generate absolute returns over a 3-year time frame. So it's irregardless of what, Combank being 11% index or BHP being 10% index, we are picking a portfolio where we are hopeful the stocks we're picking can generate a positive return on a 3-year time frame. So that's the starting point. It's very benchmark unaware. And then we break the world into 3 different buckets, which is a really simple way of thinking. But most of the cash that we allocate or capital we allocate to the portfolio is in what we would call predictable cash generating industries. And that is traditionally things such as healthcare or consumer staples or REITs or telecommunications, where those industry structures are relatively stable and the cash flows from those companies are relatively predictable. So that's 60 to 65% of the fund we allocate that way. We're certainly happy to allocate to cyclical sectors, but given the volatility of commodity cycles, we're very conscious of not having too much exposure, and that tends to be between 15 and 25% of the fund. And then what we have always done differently, and this is really since my time at HSBC in Hong Kong, investing through the GFC, we've always allocated a portion of the fund to gold and a little bit to cash. Gold and cash are the least correlated sectors or assets to the ASX 300. So it tends to be gold equities, about 8% of the fund on average over a 12-year time frame, and cash about 5 to 6% of the fund. So on average, we call that our defensive sleeve, which tends to be between 10 to 15% of the fund. And building a portfolio in those 3 buckets, it's again simple language, between predictables, cyclicals, about 20% of the fund, and defensives, cash and gold, 10 to 15% of the fund. What we've been able to generate is the alpha, successful stock picking with lower volatility. And it's the lower volatility part we really focused on, which we think hopefully makes our fund slightly different than many others.
Okay, so you've got the 3 buckets that you mentioned. Can you talk us through the investment process then that you would then implement in those buckets?
Yeah, so we think of an investment case in really three lenses. So if it's a predictable stock, and I'm going to use the Lottery Corporation or even CSL, because it's really defined by the quality of the industry position. So even CSL, which has a challenging year, absolutely it has. But we would still absolutely say that in the bearing, the IVIG space, which is 70% of CSL's profit, they are still the market leader and the lowest cost provider of IVIG. So we still think they have a very strong market position in a strongly growing industry. They have lost some share this year, and some of the other businesses, i.e. Seqirus, the vaccine business, has had a challenging year. But the core franchise, we still believe, is a very strong one. So when we're thinking about predictable investments, healthcare or telecommunications or property, it's absolutely about the asset backing and those assets being really hard to replicate. So that's the primary driver of our investment thesis. Hopefully that is met with strong valuation support and an insight, or do we think we have a better understanding of the market, the earnings stream of that company than the market? So that's what we call edge or insight, where we think the market is actually just mispricing that earnings stream. So there are three investment lenses: quality, valuation, and insight. We need at least two to make an investment case. And absolutely, if it's a predictable company like the Lottery Corporation or CSL, it's very much driven by the value, the quality of that industry position first, and then the valuation margin of safety. If it's a cyclical company, such as Mineral Resources or New Farm or Rio Tinto, it's absolutely driven by the valuation margin of safety first. So we're very much valuing the assets in the ground for a cyclical company or an energy company. So that's the way we distinguish between investing in a predictable framework, the industry structure, versus a cyclical framework, which is very much the valuation margin of safety first.
So when you're using those lenses to assess which companies to invest in, is there another risk overlay that you would then use in the assessment process?
Yeah, so we think in an idiosyncratic sense or a stock specific sense, we're very much looking for asymmetry of risk. So we're trying to minimize the downside of investment when we actually allocate capital the first time, and trying to understand the catalysts or drivers to see why that share price will be higher over the next 3 to 4 years. So the asymmetry of risk is really important to us. And then we think that through three lenses, which is the operating risk, which is what's the margin volatility in a predictable company. The margin volatility be quite narrow because those cash flows should be quite predictable and the cost base should be manageable. In a cyclical company, absolute margin volatility is quite extreme given what commodity prices can do in terms of your fixed cost base, and commodities can go up or down. So the margin volatility is high. So you're just trying to understand the operating leverage in a particular company. Then it's the financial leverage of a particular company. What's the balance sheet risk? And to be honest, my worst mistakes have been around financial leverage, where the balance sheet has been too geared. And then it's the corporate governance risk, about this is the management team and how the company is perceived with a social license to operate. So they're the three specific sort of idiosyncratic risks we're looking at assessing when we're trying to pick a stock for the portfolio.
Okay. What are the opportunities and risks you see in the market at the moment?
So as we sit here, this is the end of, we're filming this the end of 2025. So I think we're seeing some volatility around the bond yields in terms of the bond market. And that's always been a concern of ours about how the US will fund its deficits, and it's ongoing. So we watch closely the 10-year bond in America. And then what we're also watching carefully right now is the 10-year bond yield in Japan, because Japan has been used as a carry trade for a lot of risk assets or equities for 35 years. And so right now we have a Japanese 10-year bond at literally 25-year highs, with the expectation their inflation isn't under control, so they'll probably raise rates this week. So that is probably putting a little bit of pressure on the carry trade, or funds borrowing Japanese yen, keep funding, and then buying global assets to invest in, including risk assets. So I think you're starting to see two challenges with the markets next year, is that the risk appetite of actually having the carry trade in place, which is driven by that Bank of Japan decision. And then we struggle with the technology, the AI-driven momentum of CapEx spend. And the question is AI a bubble? And we tend to lean on that side where there's just a lot of capital being sunk into an uncertain future. So we can't predict what AI does in terms of the revenue profile of those companies, how they're generating returns. So that to me is uncertain. So we look for certainty, or as much certainty as we can find. And so the world that we're living in right now, I think, is more challenged next year. The caveat to that is I think Trump absolutely wants to run the US economy as hot as he can into the US midterms. So yes, the US is the one country still with an easing bias, where it looks like Australia's on hold and slash raising rates next year. The Bank of Japan is. Europe looks like they're pausing. So America seems to be the one economy that is actually cutting rates still, which is probably interesting in terms of the way we think about the dollar. So the dollar weakens. It's certainly given momentum to the commodity trade, which I think is interesting. And Trump definitely wants a sixth core recovery in the US. So I'm putting a lot of thought bubbles into an answer, which is I think the US economy can recover next year, but it will be driven by the cyclical smaller cap space as opposed to the mega, the Mag 7 and the technology space. So I think that should play out through 2026, and we sort of starting to tilt our portfolios accordingly for a cyclical recovery, I think, in the US with a lower interest rate environment, which is very much driven by Trump.
Now, at the start of our discussion, you indicated your history in running the portfolio, but what would you say Chester Asset Management's greatest strength is as a fund manager?
Yeah, I think it's a good question, because we see other fund managers come and go, and I think there's 140 different funds in the market. So it's how do you differentiate your offering to others? And if I had to use one word, I think it would be patience. And broadly speaking, I think there's two types of investors. I think there's quality and momentum investors, which has worked spectacularly well for 15 years post the GFC. And then there's contrarian and mean reversion thinking to investment case. And that's what we use. We're sort of far more likely to buy a stock that's fallen 40, 50% than a stock that's risen 40, 50%. The asymmetry of risk suggests we're trying to minimize that downside as we take that initial capital position. So we do think with a contrarian mindset. And when we're doing that, you really have to be patient. So some of our best ideas have literally taken 3 or 4 years to come to fruition. So I think rather than trying to work out exactly if the company is going to beat or miss earnings in February or August, every reporting season, that's going to drive share price volatility in one direction, we are very focused on the valuation we're paying for assets. And I think that places us as a more patient investor than many others.
Okay.
Trying to ignore, where possible, that share price volatility.
Can you talk us through a time where you've turned a period of poor performance around and made it into a positive?
Yes, I think so. Our fund broadly is very much an X20 strategy, really. So we are a mid-cap manager. And that's really, so if you step back and say, well, how are you going to generate excess returns over a 10-year time frame, which is literally how we think. And the market on average will give you 8% or thereabouts over a 10-year time frame, which is what the ASX has given you historically. So then for us, it's how do you give you double-digit return to an investor after fees, because that's what we're aspiring to. So we're very happy to be underweight the top 20 in Australia, because we think banks are utility-like, and they'll end up giving you utility-like or market-like returns. So 7 or 8% returns between dividend and a little bit of earnings growth, relatively stable, and downside risk if we ever see an impairment cycle, which at the moment it appears unlikely. But we see banks as fairly priced for a very utility-like return. Resources are, to us, idiosyncratic. So if we want to play copper, it's different than owning the big bulk miners, or lithium, or coal. There's certain idiosyncratic reasons you own different underlying commodities. Gold is different. So we have a different view on the market than the overall index. So this is a long-winded answer to your question, which is when do you underperform? And we historically underperform when the banks do well and the top 20 does well. So when there's large pools of global capital sort of entering Australia as a safe haven country, we saw this through the Liberation Day in 2025. When the market globally was uncertain about what happened to China and the US, Australia is seen as a perceived safe haven, and you see a lot of money going to the top 20 stocks. Wesfarmers, we still think is far too expensive. CBA obviously rose to $190 a share, which we see as extremely overvalued. So they're the periods of time where we think that's really hard for us to continue to outperform when the backdrops, when you've got global capital flying in the top 20. I think that's probably the most likely scenario we do underperform.
Okay. Can you talk us through some of the recent investments that you've made?
Yeah, so I've mentioned Rio. So again, we have one eye on what the US economy is going to do next year. And so Rio in the middle of the year, we have very high regard for Simon Trott, who's the new CEO. We really like the asset portfolio between copper and aluminium. And aluminium is a little bit of a derivative of copper because it can be substitutable in many facets. So 45-50% of its earnings are copper and aluminium, which we think is really well structured. And we prefer the asset base to BHP with a little bit of lithium exposure as well, and a far better cost out opportunity. So we see Simon Trott as being a wonderful CEO and rationalising the asset base. So there's far better free cash flow, we think, coming out of Rio in the next 3 years than BHP. So we were looking for a little bit more cyclical exposure. We've held Mineral Resources for a long time, and developed is this junior sort of gold, junior copper developer, which has been the fund for a period of time as well. So we have added to our cyclical exposure in a sense, along with Santos. So once the bid for Santos got rejected, Santos has fallen from $8 down to $6.30. And we see that being on a free cash flow yield in 2027 of about 15%. So we think there's really strong potential for Santos to give you significant capital returns in the next 18 months as their projects, 2 projects, Barossa and Pikka, which is in Alaska, an oil field. All the capital is being sunk literally as we speak. And then from early 2026 onwards, the free cash generation is going to be really strong. And we think that's why the bid from ADNOC occurred when it did. They obviously couldn't agree to terms or the time frame. But I think the thesis for ADNOC to buy Santos was absolutely valid because the free cash generation looks really strong here. So at $6.30, we think there's real asymmetry to where Santos is trading. So they're 2 companies we've been adding to in the last 3 months.
Okay. Now, how do you keep up to date with all of this information in financial markets and all the different companies that you're monitoring and reviewing?
It's a really good question, Joel. So we tend to think with I guess we call it a mega trend framework. How do you distill 300 stocks in the universe down to about 80 to 90 that we spend time looking at? And we have 5 broad mega trends, which are relatively well known, but we think in the world, we think about AI and technology, food and consumption, security supply, which it covers insurance and consumer discretionary names and ag names. We think in terms of energy transition thematic, which is very much driven by government policy, and which companies have the best exposure to that energy transition story. The aging population and retirement savings and income, and how that we provide for this aging population, which is obviously ties into healthcare and retirement income, which is Challenger, and then government debt levels. So that's and we think that's actually the biggest issue or pressing issue for society is how much the Western world is spending more than they earn every year. The US is spending $7 trillion this year and they'll earn $5 trillion. So the funding gap for the US government this year is $2 trillion. And that looks like it's ongoing. So that leads us to our view on having a little bit of gold in the portfolio, that fiat currency debasement argument, which we have had in the portfolio for 15 years. So that's a constant, but we think that is the biggest issue to solve in the next decade. And while we think there's still a tendency to think about commodities as a hard asset, if the US dollar continues to debase over that 10-year time frame. So they're the 5 mega trends. And then from there, we look at about 80, 90 stocks in a lot of detail. And obviously we have a team, myself, Anthony, Luke, and 2 analysts that are doing a lot of the detailed bottom-up analysis for us. And then it's just really watching the basket. So my job as the portfolio manager is to watch the basket of stocks. We hold about 35 stocks. So that's my job, is to watch that basket incredibly closely. And I'll leave it to the analyst to really drive new ideas and fresh thinking, and that we might consider as replacement for a stock that's in the portfolio today. So we really do think about the competition for capital. If we're going to sell something, what's the thesis around why we're buying something else to replace that stock? So it's really thinking about the 35 stocks deeply, and is this the best way to allocate capital?
So Rob, as a portfolio manager, in your opinion, what makes a good portfolio manager overall?
Yeah, it's a really good question, Joel. And I think I would like to say temperament. So my analysts might disagree with me from time to time, but I think you have to be really level-headed and not get too wrapped up in the exuberance of markets or the pessimism of markets. I love the saying that things are neither as good as they seem or neither as bad as they seem. And stock prices can be very depressed for a long period of time, or too optimistic for a long period of time. So we really try and remove that psychology or sentiment from our thinking, and almost in effect act on it, because if things are too fearful, that looks really interesting to us because we're contrarian. And if things are too optimistic and too greedy, then we also get a little bit cautious. So some of our best ideas that come from when the market's really fearful, and then sold stocks into the market being too exuberant on certain ideas.
Okay. Well, Rob, we've covered a lot of ground in our discussion today. Is there anything else you'd like to add?
No, Joel, I think probably the last question, or last comment I'd make is I think humility is really important, because fund managers get things wrong. We all do. In fact, Chester, fortuitously has had a pleasing 2025 to this point. But I look at the things we've got wrong, which is a lot of them. And CSL, I mentioned, has been a stock that hasn't worked for us this year. And so you sort of have to take that with humility and understand why you've got things wrong, and learn from them. Statistically, we try and get 60% right. So that means on average, you get 40% wrong. So a lot of that leaning is then to the position sizing and portfolio weights you hold about when you're going to get things right or wrong. And I say flippantly, there's two position sizes. There's too big when something's going wrong, and too small when something's going right. You want more of a stock that's going up and being successful, and less of a stock that's under structural challenge. So I think having humility with the way we operate is just a very core part of, I think, the behavioural mechanism of being level-headed and accepting what you've done wrong, and learning from it, because that's very much part of being a fund manager. Everyone's going to get things wrong from time to time.
Well, Rob, I appreciate you making the time to speak to us today, and I hope you and the team at Chester have a great Christmas and New Year.
Joel, look, thanks for your interest, and thanks very much for listening to our story. I appreciate your time.
Rob, I appreciate you making the time to talk with us today. If you'd like to talk to Solace Financial regarding your current financial strategy, and if it's suitable for your investment goals and objectives, please reach out to me and contact me via our website, or give our office a call to schedule an appointment. Thanks again for your time, Rob. I really enjoyed hearing about your investment strategy and how you reduce downside risk for clients.